I'm Charlotte McLeod with the Investing News Network, and here today with me is John Kaiser of Kaiser Research. Thank you so much for joining me online today once again. Great to see you.
Charlotte, thank you very much for inviting me.
Yeah, really happy to have you back, and we've got a lot to talk about today. I think where we will start is with gold because everybody is always interested to hear what's going on in that market. So you've been talking to us for a while about a repricing that you see for gold into that 2,000 to 3,000 type of range. So to begin, I want to get your thoughts on what happened in 2021. Was gold's performance surprising to you last year?
Gold's performance did disappoint. Its thunder was stolen by the eruption of Bitcoin. Bitcoin got pumped as this is the new gold. Bitcoin's actually an energy liability. You have to keep feeding energy into it to keep the Bitcoin alive. Gold is stored energy because you mine it, extract it from the ground, and then it sits there in its tangible form, not doing much, but it's transportable. It's there. It's not going away. And I saw in 2020 when it took off, people saw all the money printing going on to deal with the pandemic restrictions, and gold shot through $2,000. It was also a period of uncertainty about what is Donald Trump as president going to do on the global stage? What disruptions is he going to cause? And gold faded before the election in November. But it lost its momentum when the transition went to the Biden administration and relationships with the rest of the world normalized. And then there was this clean energy explosion and spec tech and then even the GameStop, Robinhood, Reddit phenomenon, and everything was momentum gambling cranking up. And this was not good for the resource companies, majors or juniors. At the time, there was this very big roaring 20s comeback from COVID, but the anti-vax movement, which was political, it made no sense. I mean, COVID was an enemy to anybody. Let's beat it and get on with life and start pursuing prosperity. All of that undermined the optimism about a global economy getting back on track and growing. In fact, the global economy did get back on track and everything bounced back far better than expected. But the anxiety about what was going on with the global stage, it diminished with the new presidency restoring relationships with the allies. And so gold, from April on, the resource juniors and the majors even, had a terrible year, despite gold hanging in there in that sort of 1750 to 1850 level. That's 30% above $400 gold in 1980, inflation adjusted to the present. And copper, nickel, all these metals were way up there. But there was this entrenched disbelief that all this is going to come to an end. The big general equity and bond bull market is coming to an end. And inflation started showing up and is being persistent. It's not going away. So gold has started to turn around, but the biggest driver is still what's now happening with Russia, Putin's crazy anxiety about the European countries. Little European countries are going to want to invade Russia. America is going to want to drop bombs on Russia or anything like that. That's insane. So he's on this megalomaniac push to, annex Ukraine and extend its influence in Europe. And that's becoming very disruptive because the real game is dislodging the United States from its top of the pyramid as the hegemon, the biggest economy, the biggest military superpower. Because if the United States doesn't do anything to these provocations, that means what Donald Trump started will be continued. And that's going to be very bullish for gold, because if China's carving up the Asian area, if Russia ends up carving up Europe and Central Asia and partly Africa, the United States will retreat into its sort of North and South American cocoon, and the US dollar will not be so important for global trade, especially when these groups start to be in conflict with each other and have sanctions against everything. Then the US dollar isn't needed for different groups to trade with each other. And that's going to be a period of turbulence that's going to push the gold price, I think, into the $2,000 to $3,000 range. And with persistent inflation, that narrative will also be in the background saying you're not going to be able to make this inflation go away anytime too soon, especially when you disrupt supply through sanctions and through conflict that simply makes stuff impossible to be shipped to where it's needed.
Okay, so gold in 2022, we look like we are going to be moving higher. There's so many factors at play. You've highlighted what's going on with Russia and Ukraine right now. I wondered if you could get into any of the other factors that you see as important for gold this year, some of the top things that you're watching.
With gold, gold has suffered from all this migration of capital into the cryptocurrencies. And as far as I'm concerned, the cryptocurrencies are simply a gambling platform. It's a solution to a problem that doesn't exist. If the Bitcoins would all evaporate tomorrow because the computers got the plug pulled on them, people who thought they were wealthy would suddenly no longer be wealthy. But the world, the global economy would not suffer at all. But you're seeing all these investment banks all moving into the crypto sector. To me, this is bizarre because the crypto sector is worth, 1.2, $1.4 trillion. The gold stock, the above ground gold stock's worth about $12 trillion right now. But this is accumulated over thousands of years, with the bulk of it in the last 100 years. And it's dispersed. It's owned by people as a hedge against uncertainty. They don't own gold for gambling purposes. So I think the rising fear factor as things become more unstable, and if this conflict escalates with China and Russia, cyber warfare will be a key part of it. And your physical gold is not affected by it. Maybe your ETF, GLD ETF is, but that's actually backed by real gold in fault. So even if there's a temporary disruption, that gold is still there. But Bitcoin, it's a digital mirage, and you're going to see capital come out of it. Now we may just see the Bitcoin deflate, the price of it go way down, and then it becomes a sort of something. Oh, why did I ever do that? We need to see money flowing in. So even as I'm trashing Bitcoin, I'm sort of saying to transfer that wealth out of Bitcoin, we need to have suckers come in and buy this off the whales who have built up all this wealth, and have them go buy gold, because of course their suspicion about everything else is not going to go away, for whatever reason. So that's, I think, a shift away from Bitcoin back to gold as a hedge against this uncertainty is going to help very much with the price of gold.
Okay, and right now we have a lot of conversations going around about Russia, Ukraine. What does it mean for the gold price? What does it mean for other commodities? I wondered if we could go in a little bit of a different direction and talk about what it might mean for mining companies themselves, whether it's the larger ones or the juniors, which I know you keep a close eye on.
Russia and China are like monster producers of metals. And in the case of Russia, also oil and natural gas. And when you see them potentially aligned, and at the Olympics, there Xi Jinping and Putin sort of shook hands and said, yeah, we support each other. If we're going to have a conflict with America, it's us against America. So there is suddenly an enormous amount of metal that's conceivably not available for the remaining economies in the world. And the mining sector, they snoozed through the 2003, 2006 Chinese awakening, the beginning of the super cycle. They forward sold all their metal. The futures curve was in backwardation, meaning the spot price was higher than the future price. And they all thought China was a flash in the pan. They didn't really build anything. But instead of the spot price coming down to reflect the lower futures price, the entire curve kept rising and rising and rising higher until in 2006, they realized what was going on. Said, oh, this China super cycle is real. We better start building new mines because this demand growth is not a flash in the pan. It will be persistent. And so that was a fantastic period for the juniors because they were the ones on the ball, found all these deposits in these frontiers that had been found before but never developed, dusted them off, and the majors ended up having to buy them and develop them. And of course, they overbuilt. We had that crash in 2008, which turned out to have just been a blip. But by 2011, 12, everything had, the growth had slowed and the new mine supply had come on stream. And we ended up in a bear market, and all the majors got punished for having overspent and miscalculated the costs. And so they didn't develop anything. And now they're in this traditional mode of, we have good memory. We're not going to make the same mistake again. And they're enjoying these very high prices that are created by the fact that there is not that much new supply coming on stream, and we're raking in the dividends or we're raking the cash and spitting it out as dividends. We're not investing. And we're now, I think, in a transition point, because at the same time we have new trends like the clean energy transformation coming in, creating entirely new demand for metals such as copper. And of course, for rare earths, the electric vehicle rollout is happening much faster than even the optimists imagined. But now we're layering on top of this a potential supply disruption. We're saying Norilsk is no longer supplying nickel to the rest of the world. All of a sudden, we have a supply shock created through geopolitical conflict, layered on top of expected demand growth and sort of a colossal depression, global depression. Metal prices are going to go, base metal prices are going to go even higher. And these guys are going to wake up and say, we need to start building new mines. And they're going to look at to see what the juniors have. Well, they already cleaned out most of what the juniors had during the bear market period. And now the question is going to be, well, we're also going to have to not rely on Africa or places where there are these super rich deposits in jurisdictions where we can mine it and be very dirty about it and have low costs. We're going to have to go back to safer, more secure jurisdictions where, even though there are bigger permitting hurdles and the deposits aren't as good, at least it's in our backyard. We need to find these and develop them. And this is the sweet spot for the juniors, where all of a sudden, unlike in that 2000 to 2010 period, where it was rethinking all these existing deposits and demonstrating that they were feasible to develop, now we have to go back to like much lousier systems, rethink them, drill them, show that they are bigger and better than they ever were and are worth developing. And this would be going back into the 90s type psychology for the juniors. And that has me excited because it's the exploration discovery aspect of the junior game that is the most interesting, that delivers the biggest upside, and that doesn't require institutional capital until you've got your first resource estimate out there and you shift into feasibility demonstration mode. And because the juniors went through that huge learning curve in the 2000s and the last decade, how to do PEAs, pre-feasibility studies and all that, the juniors can continue to do that without the involvement of a major until it's time for a buyout. So I think we're on the threshold of a cycle like that, and we're going to see we see the spec tech crash happening. Higher interest rates mean these growth fantasies based on very low alternative debt market yields. That's all going away. We're going back to a value type of a market. The big markets probably are not going to collapse because you'll see some stocks collapse and others sort of compensate. We'll probably see sideways activity, but the resource sector is a tiny portion of that. And the junior sector is an even tinier portion. And it does not take much money to inject a lot of life into the resource juniors. Once this transition happens and they realize we need to develop more supply, the world's not coming to an end. COVID is now in the rear view mirror and not coming at us like some sort of train. And that's going to really kickstart this sector. That's why I'm pretty pumped about the resource juniors after a pretty depressing year last year, following what I thought was a turnaround in 2020 when gold charged to 2,000. But it was really just gold dragging the juniors out of the gutter at the time. And when gold stalled, that sort of momentum game, which was what dominated everybody. That fizzled. But now we're looking at a fundamental outcome gambling game where it's like, what are you trying to accomplish? What's the bet? How much do we make if you're right? What do you need to prove whether you're right or wrong? We have to wait, of course, for results. So it's not this whole day trading mentality that's going to go away. And all you use a portion of all those day trading momentum gamblers to shift into a slower paced fundamental outcome gambling for which the juniors are suited. And then you're going to see the sector finally become flush with an audience and new capital coming into it.
Okay, so a trend of countries perhaps looking inward, trying to find supply within their borders with juniors to support that. And you also mentioned, this renewable energy shift and how that's going quite quickly. So maybe we can now talk a little bit about commodities other than gold that you're watching that we should be being aware of during these shifts and trends that you see coming.
Well, I think copper is the most important one because it's the, after things like iron and aluminum, it's the third largest commodity. About $200 billion worth of copper was mined at the average price from last year in 2021. And copper doesn't have to be a super giant deposit. You can also have smaller deposits. And of course, in places like Canada and the United States, there's a hostility towards open pit mining because it does visually disturb anything. Nobody wants to see another Bingham Canyon emerge, but the reality is you're not going to find big open pitable copper systems. You're going to have to go deeper underground where, using geophysics that never was able to, in the past, to look this deep, to identify targets, find something like resolution copper, which is 1,000 meters deep and is sort of offset from higher grade magma, mantle, and vein deposits that were mined forever. And this is an underground block caving operation that Rio Tinto and BHP want to develop. And it's kind of insane that it's being blocked by various protest groups simply for the sake of opposing mining. But finding these higher grade underground mineable copper systems, that's going to be very, very important because there are no big porphyry deposits sticking out of the ground in Canada and the United States anymore. They're going to be deeper. Nickel, I think, will remain important, even if nickel is not part of the electric vehicle battery that becomes the mainstream one by 2030. Stainless steel is never going to go away. So you're going to see demand for nickel to continue to rise. And then for other metals like lithium, there really isn't enough lithium around, and all the brine targets are being tackled right now. The more complex clay deposits, such as what Cyprus has in Nevada, those are now being looked at. But then also these pegmatite bodies are very interesting. And those are ones where, they don't just obviously stick out of the ground. You do have to look for them. So exploring for the pegmatite deposits, such as what's really worked out well in Australia, that's something that the juniors can do. And I think rare earths are also going to come in for revival, in particular ones that have the suite of the heavy rare earths, which China mines from these ion adsorption clay deposits. And these are a surficial weathering type system. Those deplete easily. You don't drill deeper to find more of those. China has its own depletion problem coming with that. It has no problem with its own rare earth supply for the lights, the praseodymium and neodymium, the magnet rare earths. We have to start finding deposits here. The uranium business, a lot of people think uranium's the solution, nuclear power is a solution to clean energy, but I think in 20 years, fusion is finally reaching a tipping point where things are starting to happen after decades and decades of unfulfilled promises. Fusion would change everything, but the uranium mining companies have the ability to handle radioactive materials. All rare earth deposits have thorium and some uranium in them and require this expertise. We've seen companies like Energy Fuels, all its in situ uranium mines are mothballed right now, waiting for uranium to get back into the 50 to 60 $60 or $60 plus range where it becomes worthwhile to operate them. But they're using their expertise with handling radioactive materials to start processing monazite sands, mineral sands, for the lights, and sometimes there's xenotime mixed in with these mineral sands too. So this is a potential domestic source. Chemical also, is in uranium, but it's a natural for Canada's bounty of rare earth deposits to get involved. So I think Junior's looking for these rare earth deposits in North America. I think the setup is that the uranium sector is going to become a player in the North American rare earth sector.
Yeah, that would be really interesting. And as we're kind of getting to the end here, usually we spend some time talking about companies. And I know that you have a new way that you're approaching your work with your companies in the space. So if you could tell us what you're doing there and share any last words that you would want investors to know as we're continuing on into 2022.
One of the changes that I've instituted at the start of this year is I'm no longer making formal recommendations for my paying subscribers. Individual membership still costs $4.50 a year. The platform covers all the Australian and Canadian listed resource stocks. So it's a do-it-yourself research platform with a very powerful search engine. But as part of what I'm doing for my subscribers is I'm flagging companies as bottom fish. And last year was just a bounty of bottom fish because everything got crunched, no matter how good their story, how much money they raised in the year, everything was really low in December, and only some of it has levitated a bit. There's still a lot of hesitation in this resource junior market. So I tag these things and identify what's the missing piece, because these stocks are low because there's some piece missing. And so I help my subscribers to poke through these, research them. I explain stuff. They can accumulate them while they're still going nowhere, or they can wait until pieces start falling into place and they've risen a bit and jump into them then. But when these bottom fish get their act together and start to really rise, probably doubled or tripled, then I graduate them to the favorites. And last year, favorites were behind the paywall. Now the favorites are not behind a paywall. They're free. I've got a new weekly show called Kaiser Watch, where I talk about these favorites. You can go to the website and find everything I publish on those 8 companies. I'll add some, I'll subtract some, and at the beginning of each year, I'll come up with a new crop. And so this works perfectly with my traditional audience, who are sophisticated investors, who want to buy these things, who are cheap, who don't particularly like it when I put a spotlight on some great cheap bottom fish and everybody piles into it and immediately doubles, and everybody says, well, that was useless, John. I couldn't get a position. So it's a more subtle, slow motion type of thing. And a good example of what was a sort of a bottom fish a couple of years ago was Verde Agritech with its alternative potash story in Brazil. Last year, thanks to the soaring fertilizer prices, in particular potash, they reached a tipping point in terms of farmer acceptance of this alternative to conventional KCl, potassium chloride. And that stock has hit $6. They've got the permit to expand. That's now a free favorite. I talk about it. My readers, they bought this thing at 25, 50 cents, even $1 last year. So this thing, I think, will still do well. So that's the sort of new concept. We bottom fish for these. We sort of cultivate them and follow the stories. And when they get their act together, I graduate them to the free favorites list. And hopefully all those people getting that free coverage at some point say, gee, maybe I should subscribe to the newsletter and be in on the ground floor in this bottom fish community. And I have this Slack workspace forum where people monitor. That's why I do topics off the cuff. And my subscribers are my collaborators because they're posting stuff that I don't know about, which I didn't research and add it to the bottom fish list. So it's a lot of fun the way everything's set up now.
Yeah, it sounds like a great community. Thanks for all the explanation about that. I think we'll wrap it up there. It was great to have you on to talk today.
Thank you, and you're welcome.
Okay, and once again, I'm Charlotte McLeod with the Investing News Network, and this is John Kaiser with Kaiser Research.